On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to The Money Path. I'm your host, Todd Schoenberger, and joining me today is Jed Ellerbroek. He is a portfolio manager at Argent Capital Management in St. Louis. Jed, Happy New Year and welcome to the program. We have to talk about AI. You are an AI expert, a tech expert, and we had so much with the broader averages, so much appreciation last year because of AI, because of these AI stocks. Are you expecting the same in 2026?
Hey, Todd, thanks so much for having me. Yeah, it was a big year for obviously the market as a whole, but especially technology stocks and those that are AI beneficiaries. And I guess in 2025, that trade broadened out beyond technology into a lot of industrial and contractor businesses, power-related companies that are technically industrials, but supply up into this data center construction boom that we have going on. So you saw kind of the traditional AI leaders. Nvidia comes to mind. Google is another. Palantir, CrowdStrike. There's so many, of course. Those were all strong performers, but we saw that trade, I think, broaden out a little bit in 2025.
So you
Um, I
saw
think,
you saw
go ahead.
leadership spread out, it sounds like.
Yeah, that's right.
So going forward this year, though, I mean, there seems to be the vibe on Wall Street is that it's. I mean, there's so many other items that are going on. Obviously, geopolitical events. You have commodities. You have gold, silver, everything. There's a lot of rallies elsewhere, and a lot of our attention is spread thin, to put it nicely. But on the tech side, do you see this still becoming a headline story for 2026? Whereas investors are going to feel like, hey, I have to be invested in the Nvidias of the world, or I'm just going to be left behind.
Yeah, I think so. I think where we sit today is a lot of those big tech stalwarts underperformed the S&P 500 in 2025. So I'm thinking of Amazon, Microsoft, Apple. Um, a lot of those stalwarts underperformed in 2025, leaving their valuations today attractive, I think. Even a company like Nvidia, yes, it did outperform the S&P 500 in 2025, but their earnings grew a lot faster than the stock price increased. And so that valuation has come down too. So I kind of expect going forward, I'm not sure if this will happen in 2026 or maybe beyond that, but I think that a lot of these companies that are AI beneficiaries in the tech sector today trade at reasonably attractive valuations. And I expect the market to look favorably upon some of those AI beneficiaries that have attractive valuations. And for me, at the top of that list is Amazon, Nvidia, Microsoft, even Meta.
Do you think those stocks, though, are overvalued at this point? I mean, where do they stand historically speaking?
Yeah, all those stocks trade below their historical average valuations. Um, a company like Nvidia, the bear argument on that stock would be, well, yeah, the stock does trade at a discount to its historical average, but their earnings are at such a cyclical high, that's appropriate. My response to that is, I don't think the right context for thinking about NVIDIA's business is like kind of the traditional sine wave cycle, economic cycle. I think that this AI accelerated computing data center investment cycle has broken any cyclical trend. It is a long-term uptrend in the market that's going to be a rising tide that lifts most boats, and the biggest boat is NVIDIA.
Right. Well, speaking of NVIDIA, one question that I always have is that everybody's talking about NVIDIA selling brand new chips, which makes sense. I mean, these are state of the art. I get it. Everyone gets it. But they are expensive. Is there a secondary market for used chips, a certified pre-owned chip market? Um, Whereas where I'm going with this is that I would imagine that that would invite other industries, other players that just can't afford the CapEx spend, but it would bring them into the AI fold. Is there anything like that on the horizon?
Yeah, there is a bit of a dynamic that you're describing, but there's a little bit of a twist on it, I think. So first of all, you're right. NVIDIA's chips in very high demand. The chips get, roughly like 50% better every year, but they're not increasing the price 50%. So that efficiency gain, that additional performance, per dollar cost is improving from generation to generation, which compels people to keep buying the new ones. All of the NVIDIA chips installed out in data centers today are being used. So there isn't really much of a secondary market for these chips to move from one data center to another. What there is, though, is there's so much demand for the new ones, the highest performing chips. There's not enough of those to go around. So businesses are, instead of renting out those top of the line new chips, they're renting out the 3 or 4 or 5 or 6 year old Nvidia chips, which is keeping the utilization of those very high and keeping data center utilization across the country extremely high. So today there are almost no unused data center capacity, which is, of course, a big reason why we're building so many of them today. And the ones that we're building are so much bigger than the ones that we built 2 or 3 years ago.
That's amazing. I never knew this. Very, very educational. Let's talk about those AI data centers. This seems to be the thing to do. Go out, get a building that's vacant, maybe in foreclosure or something. You end up taking it over. You throw in a bunch of servers and hope for the best. These things are popping up everywhere, right? I mean, I would imagine though you'd have to have the utility component built in as well, correct?
Yeah, that's right. That's right. The demand for data center capacity is so great that we're building them in more places and in bigger sizes than we have in the past. The developers of these data centers are typically you'd want to site one of these things within, say, 25 miles of a big city. You want to keep latency low. You want to keep response times really fast. When people go to ChatGPT, you want them to get their answer as quick as possible. The best way to do that, put a lot of high-powered chips in that data center and site that data center really close to an urban area. But as the demand for these data centers rises, developers are having to go further out to build them. So instead of 25 miles away, we're 50 miles or 100 miles away. And some of the biggest training-oriented data centers, like what Oracle's building out in West Texas, are not sited near a big city at all. We will do model training there and then run the inference workloads at data centers closer to the urban areas. The risk with what Oracle's doing, with what other companies that are doing, building data centers away from urban areas, is you risk that becoming a stranded asset after 5 or 6 years. After that first OpenAI training run in West Texas, what purpose does that data center have 2 or 3 years down the road when those are 2 or 3 year old Nvidia chips inside and it's not appropriate for the next training run? Will there be demand for that data center space at that location with that age of semiconductor chip?
Let's expand on this a little bit. So let's use that example. 3 years, 2, 3 years from now, when Oracle has an outdated chip, can they easily take a new chip and just plug it in?
That is expensive to do. Oracle, in the example we're talking about, out in West Texas, they're installing Blackwell chips from Nvidia, the 2025 class version from Nvidia in those data centers. The depreciation schedule for those chips is probably 5 years on Oracle's balance sheet. So they are going to be incurring and recognizing expenses related to those Blackwell chips for 5 years. Ripping them out after 3 and replacing them with something else would be very expensive. You'd have to take a bunch of charge-offs related to the remaining value of those chips that you haven't depreciated. So that is not an ideal circumstance. The biggest cloud computing businesses, the Microsofts, the Amazons, the Googles, their main focus is building data centers that will be fungible from one workload to the next. You want to build data centers in a way that they can switch from workload to workload over that life of the asset. In the case of the chip, it's 5 or 6 years. In the case of the data center itself, the building, the walls, that's like a 15-year depreciation schedule.
So what does Oracle know that we don't know then? I mean, why would they build this knowing that in just a handful of years, it could be just a used property?
Yeah, they have a huge volume commitment contract from OpenAI. And so
Hmm.
their bet is that OpenAI will deliver on that contractual promise, that they will grow, that OpenAI will grow dramatically, and that they will take up all that space that they've contracted for the full term of the contract. And I think that that's a reasonably that's a reasonable business case. OpenAI, of course, is a small company today in the context of technology, like by revenue, but their growth potential the ingenuity of the products and services that they've been bringing out, are obviously outstanding. And there's a really good likelihood that OpenAI turns into, a big tech company in 5 or 10 years as they grow.
Yeah, and I could see that happening. What about these smaller data centers, though? Are they just run by entrepreneurs, independents, and they may run a risk, I would imagine, down the line of becoming obsolete as well, correct?
Yeah, for independent data center developers, and there are publicly traded companies that do this. There are also, private companies that do this that are much smaller than the publicly traded ones. The risk that those companies face is that the customer base renting the space and the power capacity and the compute capacity in those data centers is largely like the big cloud computing companies. So you've got really big customers. They have a lot of negotiating leverage over you. They're very tough to negotiate with. So that is not a terribly compelling business model
Hmm.
from our standpoint.
Wow. Now we'll see what happens then down the line. It's interesting. All right, so tell us about the Argent Fund. What are your biggest holdings? I know it's probably spread out across the board, but are there any particular equities or stocks that you can might be able to speak on that are probably your favorites or where you see breaking out in 2026?
Yeah, sure. Yeah, so I manage Argent's large cap strategy. So kind of a core large cap strategy. We have an ETF that we offer that people can buy at any of their brokerage firms. The ticker is ABIG, ABIG.
Okay.
Argent Large Cap is invested really across the large cap landscape. We do have quite a bit of tech exposure. Tech is the biggest sector in the S&P 500. We also own a bunch of non-tech companies that we think are special businesses. The investment philosophy that we use to invest Argent's capital or Argent Large Cap's customers' capital is an enduring business philosophy. That's what we call it internally. And there are three components of that. The first one is we're looking to buy businesses that have secular or long-term growth prospects, not cyclical short-term growth opportunities. We're also trying to buy businesses that have a durable competitive advantage over their peers that allows them to earn high profits both today and going forward. And then finally, we want to invest with businesses that are run by a management team that has experience and past success running that business, but also taking the company's profits and reinvesting them in shareholders' best interest. So that's the kind of three pillars we're looking for. In terms of top holdings and our favorite ideas today, Nvidia is our largest holding at about 9%. Amazon
Wow.
is close behind. Amazon is probably our favorite idea today, and it's the biggest active weight in our fund. We've owned Amazon for years and years. We think it's an especially compelling purchase today. That stock was practically flat in 2025, even though their earnings grew 30%. And I think they're
Hmm.
going to be able to grow their earnings at 20 to 30% for the next 5 years. That stock is attractively valued today, in our opinion. It actually trades well below their historical average over the last 5 or 10 years. And we think CEO Andy Jassy, who seems new to me, but he's actually on year 4 or 5 there, is doing a great job. And we think the company has wonderful growth prospects, both in retail, where they're dominant, growing about twice the speed of their big retailer peers, Walmart and Costco, but also their cloud computing business, where they're the largest, growing over 20%.
So AWS though is just, I mean, it's growing exponentially, correct?
It is, yeah. I mean, there are three cloud computing giants in the United States. Oracle's
Yeah.
vying to be the fourth. The big
Okay.
three are Amazon, which has about 40% of the market. Microsoft's Azure unit is at about 30%, and then Google's GCP is around 20% or so. Uh, all three of those businesses are growing anywhere from 20 to 35%, depending on
Wow.
their size. Amazon's growth, AWS last quarter, I think reached 21%, if I recall correctly, and I do think that's going to accelerate throughout 2026. They're all accelerating. And the other compelling thing about that business, besides their growth, is the margin profile. Amazon's profit margin in AWS is over 30%. So
Oh,
that is a highly capital intensive business. We all hear and talk about the CapEx spending that these companies are doing, but that CapEx spending is enabling significant revenue growth and really high profit margins on those revenues. So we think that's a very compelling industry. It's probably the most compelling industry for investment in our perspective, and that's why we're overweight not just Amazon but also Google and Microsoft.
So on the in the fund, do you have to rebalance though? I mean, I would imagine that with the appreciation in the tech sector, it's a large cap fund, but it could actually turn into just a tech heavy fund, right?
Yeah, it's a fine balancing act.
Hmm.
Argent large cap, so we own about 30 stocks. We're trying to invest in our best ideas under that enduring business philosophy that I described earlier.
Hmm.
Um, we're also trying to have a balanced, diversified fund that has exposure to all of the compelling industries in our country. And so, you can see a little bit of inherent conflict there. A lot of those compelling industries are in tech, some of them are not. We want to be broadly diversified, but we also want to invest in our very best ideas. So that's a trade-off that we're kind of constantly evaluating in the fund. Um, in 2024, for example, if I recall, Amazon was a very strong performer that year. It grew as a percentage of our fund, and we kind of faced the decision: should we trim this back just from a risk management standpoint, or should we let our winners run? And we
Yeah,
try, our bias is to let our winners run. In my investment career over 20 years now, that letting your winners run philosophy has worked for me. But there obviously has to be a limit to even good things like that.
that's impressive. Any idea off the top of your head? Do you know the performance numbers from last year?
For the fund,
Yes.
yeah, yeah, yeah. I think that for disclosure rules, I should probably limit my
Oh,
my
don't worry about it.
comments. I'm
We'll
sorry.
have everybody go to the website.
That sounds great.
We'll do it that way. That's great. Jed, do you see well, the final question for you? Just a quick question about the overall market. What is your outlook, though, for this year? Everyone I've been speaking with, they're expecting a lot of volatility. We've seen it already in the first 2 weeks. You expecting this to be the trend for the remainder of the year?
Yeah, yeah. When I look at what I think of as like the building blocks for our stock market, the main inputs that determine whether our market goes up or down. What I see is um, a bunch of things in the positive column and not a lot of things in the negative column. And the things in the positive column for me are double-digit corporate earnings growth. The S&P 500 is expected to grow its earnings in 2026 14%. That's pretty darn good. I also see the Fed lowering interest rates. I see M&A activity rising. I see IPO activity rising. I see tight credit spreads. I see the equity market at a record high. I also see
Wow.
some tax benefits coming from Trump's tax bill that was passed about a year ago.
Hmm.
In the negative column, inflation has been a little sticky, a little higher than people would probably like. That's given
Hmm.
some industrial companies and consumer companies problems. And valuations are a little high. But when you kind of tally those up, I see a lot more positives than I see negatives. It feels weird to predict another sizable up move, in 2026 after three straight really big years in a row.
Yeah.
But gosh, there's a lot more things in the positive column than the negative column.
Can you imagine if you were on the sidelines 3 years ago and you decided to go into cash and you missed this and you kept waiting for that sell off to happen and it just hasn't happened? I would just go nuts, actually.
It's like my favorite football team losing 12 football games in a row or something like that.
There you go. Absolutely. Jed, you always bring the best. I really appreciate you joining me. Can't wait to have you back on again. We have to talk more about tech. I know it's going to continue to be a great story, and I know the fund is going to do well as we proceed forward into this year.
Have a great day. Thanks so much.
Thank you, Jed. So, on behalf of Jed Ellerbrook, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care. All right. That was great, Jed.
Awesome. Awesome. Thanks for having me.
Yeah, thanks a lot. Sorry about